Welcome to Phil's Gang, and I am Phil Grandy, and I'm sure you know that from listening to my radio show. This is an hour that we're going to dedicate to to you for those folks who never looked at a chart. You hear us every day on the radio, or hope you do, and you're curious what we do. And when you hear us talk about the returns we're making of, uh, you know, 25% on Hess and BAC 20%. You hear me say that every day. You go, how do they do that? But let me first start out by welcoming you, and then I'm going to give you an introduction. Then Steve's going to come on, and then we hope by the end that you will decide to join the gang. So when we finish this, you today, if you join the gang today, you get 29. It's 39.95, but you're going to get the color coded chart that we're going to be showing you through this next hour. It's fantastic. You get that for free for 1 month. And we hope at the end of that month, okay, that you will really say, this thing works. It really works. So we got 1 month to convince you, okay, that this works. And all we ask is to judge us by our performance. But let me go back and start with, we started all of this about 40 years ago. And I've been doing it. The Phil's Gang is about 20 years now, but I've been doing this for over 40 years. And the real problem that we have right now in this country, of course, is a retirement crisis because the 401k never worked. And it was interesting. The 401k never worked. People didn't know it because when it was introduced in 1978, that's when we had the wonderful market from 1978 up to 2008, and people were making money. So they didn't know they were getting screwed. They didn't know it was a bad product. But after the stock market crashed, they started to learn that they did get screwed. It's a horrible product, and that's why we have the retirement crises. And we're going to get into that today a little bit about your 401k. But I'm not here to put your 401k down. You keep your 401k. You make that judgment. But I'm asking you to look at our product, okay, as a way to subsidize your product, especially to mitigate the losses you always have on your product. Because the one thing about 401ks, they can tell you on a 401k you get 5 to 8%, 5 to 7% return, which is not true. Most of the returns you get, if any, maybe 3%. 4% if you're lucky, because the fees are outrageous. And here's the big problem. You never get out in time. When the market crashes, it's too late. You always got to be out of the market before it crashes. And I'm going to show you how with the chart that I created, okay, and with the algorithms I use, it identifies the money. Where's the money going? And the only thing that moves money around, and remember, the stock market goes up 70% of the time. What moves stocks are the big institutional buyers. You can't move a stock. No retail member can. And it's the institutions. What are those? Those are the big banks, the 5 biggest banks, the 5 biggest insurance companies, the biggest hedge funds. They all work together, okay, in buying stocks. When those stocks go up, they're all in there buying. And when they're ready to pull the trigger, you're not going to know that. Okay? When they're ready to pull the trigger, they will. And that market drops right down. They pull their bids right out, and the market goes down 10 times faster than it goes up. So I'm going to get into all that today and show you how that works and how they keep you in those things. But first, I want to talk about why we're really here. It was, my son had cancer. And when my son had cancer, that's when I got involved with St. Jude research. And I really got involved in it. And it was amazing because I knew nothing about it. And the most common childhood cancer is leukemia. And in 1962, when Danny Thomas started the St. Jude cancer research, the survival rate of leukemia for kids was just 4%. 4%, that was it. So that was pretty bad. So he was dedicated to getting that survival rate up. And so he started the St. Jude. Everybody thinks of it as St. Jude Hospital. It's a research hospital. It's one of the best research hospitals in the world. Today, that leukemia survival work has gone from 4% survival rate from 4%, 1962, to 68% today. That's pretty good. But there's even better news than that. If you take the overall survival rate of all the different child's cancers and child diseases from 1962 to today, it's amazing. The survival rate has gone from 20% to 80%. And how did that happen? Because of folks like you that donate to St. Jude and my members. But I never asked my member to donate, to put, what I mean by that is, I always tell them, if you make money, if what my team does, and if we get you to make money, just take a little bit of that money and give it to St. Jude, because there's no better cause than St. Jude. And it's hard to explain that unless you had a child with cancer. You can't ever get that across to anybody. I hope to God you never have a child with cancer. Anybody that's going through it, you know what I mean. So, and that's how you get it. Once that happens, you get to know St. Jude, you get attached to St. Jude the rest of your life. So I decided when my son survived that I was going to contribute, and I didn't know what to do. So I finally decided that the timing was interesting, because remember what happened to our country. We were in this boom area, of this industrial boom. And then finally they switched from an industrial boom. The big boys, they're very wealthy. They wanted to switch our economy from industrial to financial so the very wealthy could make more money. So we took all our industrial and we shipped it overseas. You know all this. I don't want to get into it too deep. And so we shipped all our jobs. We shipped everything. We took our factories, dismantled them, sold them to China, to Japan. Soon we were nothing more than a financial service economy. The stock market used to be a rich man's stock market because you couldn't afford it. Because the average guy could not afford it, because in today's dollars, a fee was $300. Just the commission was $300, for God's sakes, okay, in today's dollars. But here's why it was worth it for the wealthy, because that broker he worked with, they had a fiduciary relationship with that broker, just like with their accountant and their doctor. And lawyer, they had that same kind of fiduciary relationship. And the broker then, the money manager, was making a lot of money. So he worked hard to find undervalued companies, meaning that you'd have these great companies and the management would screw it up and the stock would tank. And that wealthy person working with that broker, his money manager, his guy, would find these undervalued companies for him. And they'd go in and they'd search it and do all the work and hard work, and it was worth paying that kind of a commission. And they would take that company, get rid of the management, of course, and then what would happen is the company would turn around, and over 4 or 5 or 10 years, you would stay in that stock, some 15, 20 years. That's how you made good money in this industry. So the broker was making great money, and so wasn't the wealthy making great money. But when we switched from an industrial nation to a financial nation, at the same time, it was amazing. The sun, the stars, the moon, everything was lining up. It was called technology. And with technology, Wall Street discovered we can get the average guy in on this and screw them. Now, with technology, the advent of technology, they could bring commissions down to 0. And by the way, they did. In fact, J.P. Morgan was the first to bring it down to 0. Now, this is after the discount brokers started, to 0. And you remember discount brokers, they would take fees that would go from, they started out with $12 fees, and $10 fees, and 5, then 4, then 2. And then, of course, as I said, they would take the discount brokers like J.P. Morgan came out and it just slaughtered. I mean, I think it was AMTD. I remember the day that it happened. I'll put it up later, and the thing just collapsed. So we entered an age now that with technology, they could invite the masses into invest and take advantage of them. But what happened was no longer were they going to give them the research because they couldn't get $300 a fee anymore. The fees weren't $300; they were $5, they were $12. So you got to ask yourself, well, if they went from $300 fees to 5 to 12 to 5 to 2 to 0, how the hell did they make money? Because what changed was the fiduciary relationship. No more fiduciary relationship. What's that mean? The big firms decided to go out and buy the stocks first. They didn't do that when they were charging you $300. They were actually a true broker. The relationship was they were in the middle. They didn't buy the shares of stock. Well, with the technology, and at the same time, we had the dot-com come in. You remember that. We had Enron, if you can see on my chart, and as an example. So with technology stocks coming in and the IPOs, every day they're bringing new stocks on. In the morning, it'd be at $5. And then whether it was JP Morgan or Citi or Bank of America, they would boost that stock up to $40, $50 by the afternoon. And they only could do this because of the technology they had. The technology was in to do that. And that's how they could trade. They set their computers up right on New York Stock Exchange, right next to the New York Stock Exchange computers. They could front load them. And they also could run the prices. So what has turned to a beautiful business with a fiduciary relationship between your brokerage firm and you for years and years and years, that's out the window, gone. Now it's turned to be a big skimming operation. And that's when the 401k came in, because the 401k is the biggest skimming operation, because the industry who introduced the discount brokerage, okay, also remember they started to introduce the 401k. The 401k is why we have a retirement crisis. And as I said in the beginning, the reason that the 401k was so bad, because it was never intended to be a retirement vehicle. A 401k was a product. Matter of fact, if you think about it, it's the only product that Americans buy, and they don't know the price of it. They don't know the quality of it. They don't know the danger of it. And what it was is it was set up to be part of the pension plan. So CEOs had these wonderful pension plans, and it was intended to supplement the high-paid executives' pension. So in other words, all the perks they would get, they could put in this 401k so they could shelter the tax or whatever bonus would go into 401k. They get a golf course membership, go into the 401k. So the 401k was designed to supplement the pension. The 401k would never be touched. The executive didn't need to touch it to go in and get money out of it to help the kids at school, to go to college, or go in because I need money because of my mother's in the hospital and I got all kinds of medical bills. I better go in my 401k. It was not designed for that. But then what they did when the the tech revolution came in and we got rid of all our factories and shipped everything overseas, all the CEOs said, look, why would we keep pensions? They're very expensive to maintain. So when all the unions, remember the unions were busted and everybody went overseas and they got rid of all their help, they finally said, why would we keep carrying these pensions? They're too expensive. Because remember the difference between a pension and a 401k. The manager of a pension, he got paid only on performance. if you made money in a pension, that's when he made money. If you lost money in a pension, he lost money. So they used to have to get the best pension manager around, and it was very expensive to manage pensions, whether it was for GE or IBM, whoever the pension manager was, cost big bucks. So now with the factories being shipped overseas, they got rid of the pensions, and they turned around and they said, okay, we'll change it and we'll call it a 401k, and we're going to do you a great deal, because a 401k means you can be just like Buffett. You can invest in your own stocks. Well, the problem with that is a guy who works a machine all day, a lathe machine. What's he know about investing? He knew nothing about investing. So wait a minute. So now you're saying with the 401k, I can be like Buffett because now I can invest. Well, the problem is I know nothing about investing. I know how to work a lathe machine, but I don't know how to invest. Oh, we're going to set up what we call planning. So the whole scam started with the planning industry. Another scam. Oh, we're here to help you. We're going to take care of you. But they would never sign a fiduciary relationship. And for years, the reason why the industry would never sign a fiduciary relationship, and the millions and millions of dollars that they pay lobbyists to make sure they pay off Congress to make sure that doesn't happen, is because, remember, they buy the stocks first. They're not making $300 anymore, a commission. A round trip of $600. Where today a round trip is what? $4, $5? So think about it. The whole industry wanted to make sure that they could continue to buy the stocks first and then sell them to you. And during that dot-com era, when all the IPOs came out in the morning, they bought the stock first at 5 and sold it to you at 10. Then sold it to somebody else at 50 and sold it to somebody at 50 by noontime. And it continues today. Every time they sell you a stock, it's called in-house stock. What does that mean? They buy the stock first. So let's say let's say it's going to be GE. And then what they're going to say is, okay, they say to their sales team, everybody, you got to sell GE. And here's your script. And by the way, whoever sells most of GE, you're going to get a World Series ticket. Whoever sells GE, you and your wife are going to get a trip. So the whole thing was they take whatever stock they want and they push that stock because they bought the stock first. So they buy the stock first and then they mark it up to you. Well, how the hell is that going to work? If you go to Walmart or you go to Home Depot today and you buy a wheelbarrow for $100, do you think you go out in front of Home Depot here on a Saturday and put a sign $200 or even $115? No, because that means you got to be the dumbest person in the world thinking if you go in and buy a wheelbarrow at retail and you go out in front of the store and sell it at retail. That's pretty stupid. Well, that's exactly what you're doing with the stock market. You're buying stocks at retail with the idea of selling them retail. The only person who makes money is these guys on Wall Street. So trading started, all the day trading started, right? And then they showed you all the different charts and they say, well, look, listen to me because I know the fundamentals of the company. I know everything about the company. I know the PE ratios. I know, and people say, well, God, he knows everything about the company, so I'm going to go with him because I don't know anything about free cash flow. I don't know anything about margins. I don't know anything about PE ratios. And they would always tell a story about the stock. That was the whole idea. Keep telling you a story about the stock, why you should buy that stock. But remember, when you're buying it at retail. Here, give you a little example. When you have a stock that's going up, as the stock goes up, think about it. They got once the stock I have to laugh at this. What they do is when a stock drops, okay, and starts dropping, and they have a buy signal on it, right? And you always look how many strong buys. You ever notice there's always strong buys and buys, but very seldom is there ever a sell recommendation? It's all buy, strong buys, buy. And as the stock starts at $85, like Enron did, and when Enron collapsed, okay, and it started to drop, It was at $80, then went to $75, then to $72. But they still had the recommendation on it, buy. So they had a buy recommendation at 80. They had a buy recommendation at 70. They still had a buy recommendation at 65 because they were telling you you could buy more of it cheaper. That's called cost averaging down. If anyone ever tells you to cost average down on a stock, fire them. Matter of fact, it should be illegal. Their ticket should be pulled from them. Cost averaging down is the biggest scam in the world. And just like Enron right here. When Enron, every time it would drop, and oh man, there's no more 80? Oh, you kidding? So I can buy it at 60 now? Wow, you call your wife on the phone, boy, my broker just told me, hon, we Enron at 80? You know how we bought at 80? He said he thinks he can get me more stock at 60. Oh my God. Oh, then he calls back. Hon, you there? Oh, he just told me we can buy more at 50. We can buy more Enron at $50. Isn't that great? Can I take him home for dinner tonight? Because I want to really befriend him. I'm going to take him golfing. He's my best friend. Then all of a sudden it's down to 30. Called cost averaging down. The biggest scam. Now, why do they do that? Because who are they responsible to? The big brokerage firms, to the institutions, to the union, to the police department union, to the fire department union. So J.P. Morgan, their fiduciary relation is only to the institution. They're called institutional buyers because it's the institution buyers in this industry that keeps the whole stock market going. It's the institution buyer, their money going in, okay, that makes the market go up, or the institution money coming out that makes it go down. There's no magic to this market anymore. Forget they're buying undervalued stocks and you get in there at $10 and you hold on it for 10, 15, 20 years. Now it's at $60. Those days are gone. Because remember, in those days, you bought wholesale. Your broker worked hard for you to find that undervalued stock that was at $80, now it's $50, and it's a wonderful stock. It had bad management. You get in there, you wait 10 years to build, that's how you made a fortune. No more. So now, on the way down, all they're doing is taking care of the pension. So on the way down, they got strong buy, strong buy. So you're saying, well, if it's 82, now it's 72, how come it's still a strong buy? But people thought it was. And they start buying more of it because the brokers told them cost average down. Because what they were doing is getting the pensions out. They're getting the fire police. So J.P. Morgan would paint the tape saying it was a strong buy. Even though they kept the strong buy recommendation at 80, they kept the strong buy recommendation at 65, they kept it at 60, and they kept selling you, the retail customer, that stock, saying keep cost averaging down. They did that so they could get the fire union out. They could get the police union out because their relationship is with the institution. The retail customer is the sucker in the game. So now you know why I'm not on TV, right? Okay. So now it goes all the way down. I'll never forget Kramer. Kramer comes in and he says when it was at $25, and he said, if you don't buy Enron at 20, you got to be a fool. You got to be a fool. And he had a couple of, they had the emergency group right around. You know how they do that. Breaking news, emergency group. So they're saying, oh yeah, you got to buy it at $25. And she ran back up. And then that was the last collapse. Then she dropped like a rock and everybody lost everything. So now let's bring you to, that's Enron. Now let's bring you over to what happened from there. Okay, what happened from there in 2008 when the market crashed? They had to figure a way to stop the crash. That's when they activated the plunger team. What's the plunger team? Ronald Reagan, when he got caught in his market, downdraft in his market, he started a team called the plunger team. It's called the President's Working Council on Market, a.k.a. plunger team. It's the head of the SEC, the head of the SEC, the head of the Chicago board. There's 5 of them. I'm not going to go through them. There's 5 of them. Treasury Secretary, the head of Treasury Secretary, and also the Commodities Futures Trading Commission chairman. So there's 5 big shots. Every morning they get together and decide, okay, what are we going to do with the market? We got to push this market up. Ever notice in the morning, if you look on like CNBC and you wake up in the morning, you look and you see what the bug is saying, and it'll say implied open, and it looks like almost every morning 35, 45. Ever notice that's always 35, 45? Market go down the day before 200 points, but the next morning you wake up, it's always implied open 35, 40. Well, how come if it went down $200, it went down 200 points? How come the next morning it's positive 35? What changed overnight? Nothing. What changed is the plunger team goes in and buys early in the morning contracts. Okay, futures contracts. And I'm not going to get into all that because I don't have that much time left. So what they do at that point, they go in and they are able to control the market. They're able to push the market up. They can push the market up in the morning. So the bottom line is I decided everybody's getting screwed. So the bottom line is it's all about knowing when those institutions are in and when those institutions are getting out. So let's just follow the institutional money, and I developed the MV2 color-coded chart. And it even talks to you. What it does, the chart, and here's an example. Here is what is KHC, Kraft Heinz. Do you remember when Kraft Heinz collapsed last week? My gang got out. The members, we didn't have a lot of members in, but I should say we had a pretty good size amount of members in, but they were in, it was green. See how it was green? It was green, 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 green. And then 2 days it turned red. So they knew to be out. Something was up. So the algorithms pick up, are the big institutions staying in? Or are they getting out? All of a sudden the money starts flowing out. It shows you that. And that's why it's so hard to convince people when I'm on the radio trying to do this, trying to reach out to people, tell them, forget all this nonsense that's going on with fundamentals and what the company is doing and what it's not doing. Those days are over. You only want to know one thing. Remember, it's all the big firms, JP Morgan, Goldman Sachs, Morgan Stanley, all of the big companies that represents all the big institutions and the insurance companies. Remember, they're taking care of them. So let's follow the money. So here, let's go back here. KHC was green. It turned red. That meant money was coming out. Now, here's the difference with you and your 401k. Your 401k, they don't allow you to sell the stock short. Well, when it turns red, see how it went down? So it started out here on my chart that I designed that follows the institutions. It was around $55 on October 24th. It turned red. So my gang members who have this stock started to short it because it turned red, because it's telling them take your money out. It went from green to red, and it dropped from $55 all the way down to finally turned green at about $46. So that was a drop that's about an 18% drop. But see, in your 401k or your money manager, he's not going to call you and tell you that, is he? No. So, but my members, we tell them at 2 o'clock in the afternoon, every 2 o'clock in the afternoon, if they're with our working investor group, we always post the same 5 stocks we've been in for 2 years. The same 5 stocks we've been in for 2 years, we tell them, okay, what to do. So we would have told them when it turned green to start shorting it. And we show them how it's easy. And they don't have to know anything about the candlesticks. They don't have to know anything about the stock. They don't have to know anything about the PE ratios. They don't have to know anything about the margins of the company. They don't have to know anything about the management. Nothing. All that crap you hear Kramer talk about, don't need to know any of it. So it turned red. So we had a nice return. Then when it turned green, that's a buy signal. That's a buy signal, and it works. So it started to go sideways. It was green, so I won't get into the details because I'm almost done here because I'm going to put Steven on. But look at this. It started to turn red, and then she dropped, Okay, so they got out. They were safe. But anybody in the 401k, you're screwed. Let's take AUI. Here's another one. AUI, it started to turn green AUI started to turn green on around $10. I'm sorry, AU. That's what I said. AU started to turn green. It was red, started to turn green. That means it was a buying opportunity. Okay? See right here, that's gold. We know nothing about the company other than gold. So it started to turn green. So it went from about $10. I'm sorry, it went from about $9. It went all the way up to about $15, $9 to $15. So that was probably about a 5%, say 6%. Then we knew it was time to get out. This is where it counts. Because think about it, 72% of the time the market goes up, but you're losing money. You're losing money. So because you don't know when to get out. Not only do we tell you to get out, but we tell you to sell it short. We give you the instructions. If you just follow the instructions, okay, that's all you have to do. Give you one more. We found this wonderful, this was the 20-year Treasury. See how it dropped? It was red, 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 red. We weren't in that when it was dropping. All of a sudden, we spotted it was green. Started to turn green. Look, right on the bottom here. So we started to buy it. See that? Nice and green. So we're buying it. But what we also do is put stops in so that when we tell you to buy a stock at a certain point, we make sure that you can't lose more than 2%, 3%. But your risk to reward is you're risking 2 to 3% to make 10%. And I'm going to let Steve get into all that detail, what we call stops. But I just wanted to show you, this is what I talk about every day. It works. Valero, here's this one of the stocks we're in. Look how it dropped all the way down. It was red, 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 red. Now, we weren't in this one, so we didn't catch the drop on the way down. But we did spot it when it started to turn green because we watched this group. So we started to buy Valero. It was around $77. And then it hit $82. $82. So that was about, what, 12%, I think? Something like that. Yeah. I'm 6.5%. But here's the deal. It turned red, telling us to get out. So we have our money in our pocket, but better, we turned around and we started to sell it short. So my point to you is, here's the deal. Right here. Here's the deal. Here's what you've got to realize. They are going to continue. Okay, right here. We can't get that up. Let me see. Let me see. I don't know why I'm not getting it up. Hold on a minute. Okay. So, yeah, right here. Okay, here we go. So when the stock market crashed in 2008, they had to stop the market from crashing. So that's when they printed money. That's called quantitative easing. They print money and they buy the 10-year Treasury to make sure the interest rates go down. We're paying on our national debt, the interest, 3.7%. That's what made the market crash. To stop the crash, what they do is they go and print gobs of money, $85 billion a month. Okay, over $4 trillion buying these treasuries, because when you buy a treasury, the yield or interest goes down. So the interest on our debt went from 3.7% down to 1.1%, then down to 0. So that's how the rally began, as long as they keep on buying these treasuries, and they did. And then what happened is they kept on injecting money in. They did it. I mean, it was amazing how they injected this money in. It was, let me see if I can find every month, every day, what they were doing. Let's see if I can get here. I don't, for some reason, I can't get that up, but here it is, right here. So what they did, QE1 starts on November 2008 to stop the market crash. They went in and they put in $1 trillion. They bought $1 trillion worth. This is the plunger team. They buy $1 trillion worth of stock to artificially push the market up. Then it went up 80%. And then it was starting to fall again. So on November 2010, they printed another $650 billion, injected it right into the stock market to push it up again 33%. Started to drop again. They printed another $400 billion, the plunger team. Okay, now every time they print money, when you go to the grocery store, you ever get a bag of potato chips? You ever notice half of it's there? That's how they can do it, because the dollar is getting worthless. The value goes down. You can't go to the supermarket and buy stuff anymore. It's so expensive. They put half the potato chips now air in the bag, or the prices are so high because your dollar is so low. So they put in $1 trillion on November 2008, another $650 billion in 2010, another $400 billion on September 2011, another $1 trillion on 2012. Oh my God! So let's see. They bought $4 trillion worth of treasuries to get the interest rate down to zero, and then they front loaded the stock market to push the market up. Okay, about 160%. And they're telling you the reason why the market was going up is because the economy's great, the economy's good. No, it has nothing to do with it. So here we are today. We're back in February 2019, and the market crashed 20%, right? And now it's going back up, and they're telling us how wonderful it is. So you can't believe what you hear anymore, because once they change from where we had honesty in the market, and the broker worked hard for you, and he charged you $300. And when they went to discount brokerage and they let everybody into the market, that's when it was rigged. They started to buy the stocks themselves first, the market up to you. So the only way you can make money in this market, just one way, and that's why my gang does so well, is by following the money of the big institutions. And that's exactly what we do every day. And that's how every day we're as I say, every day, what happens at 9:30 in the morning when the market opens, we have our 5 stocks, and Steve will go through that with you. And you got 2 choices. You can either do the 5 stock program, where we tell you what to do every day at 2 o'clock in the afternoon, or you can become an activist investor, where you can learn how to trade yourself. Okay, we teach you, have a great academy. We show you how to do that. But the MV2 color-coded chart, here it is. I'm asking you. I'm reaching out to you. I'm telling you, this works. The color code works. Look, if I can reach out to you and you join the gang, and this gang's been around 20 years, not only in the United States, all over the country, all over the world, it works. All I'm asking you is just help St. Jude a little bit. That's all. So we start out with in the 5 stocks that we work every day. We start out with Goldman Sachs, Intel, AT&T, Caterpillar, Schlumberger. Why those 5 stocks? Because the big institutions have them in their portfolio, and we zone in on those. You don't need 20 stocks, 30 stocks. Every day you don't need to turn to CNBC and what's the hot stock of the day, or turn to CNBC at lunchtime, what's their hot stock at noontime. That's all a joke. All right. So please sign up, help yourself, help your kids. Obviously, you're helping us with being a member, but the St. Jude's is worth this, believe me. Okay, I'm going to turn you over to Stephen now, and he's going to get into the particulars of these charts.
Hello, everybody. My name is Thomas, and just give us a second. We're going to switch our screens. We thank you for attending this free webinar. And if you got in a little bit late, we will be posting this at philsgang.com under the video library, free videos. So again, if you came in a little bit late, we'll be posting this video at philsgang.com under the video library, free videos.
Okay, good afternoon, potentially new gang members. My name is Steve Celeste, and I am one of the senior chartists here at philsgang.com. And of course, thank you, Tommy, for the nice introduction, and a great job to Phil. He always does a really good job explaining the markets and and why we're all here. So now that you're here, you kind of probably want to know what to do. How does this all work? How do you make it happen, right? So the first thing, obviously, is join Phil's Gang. Okay, when you do join, if you get to the website, you're at the home page, you click this why join, it gives you a real quick rundown of what we do. Okay, there's a couple videos here to kind of basically reiterate what we just talked about. But this is what's included in the Phil's Gang membership. You get your coffee talk, okay, every morning, right at around 8:30 a.m. Eastern time. Phil does anywhere from 5 to 20-minute coffee talk, basically explaining what he feels is going to happen with the market based on what has happened in other markets around the world and how that'll affect us for the day. And then at 9:30 a.m. Eastern time, we do a 1.5 hour live trading class. It's a webinar just like this. We do these every day, Monday through Friday. The only time we're not here is if the stock market happens to be closed, then we all take the day off. But Phil starts off the class every day. He goes over the market again. He lets you know how to handle the market in the first 40 minutes of the market. And then from that point, he hands the class over to me and Tommy. And then what we do is we receive email questions from you, the gang member, and we answer your stock questions in class. And I go over your stock in great detail. And me and Tom, we're going to do a small demonstration of that here in a little bit. The other thing that's included in the gang is also in your membership is the Working Investor Program. If you don't have time to do coffee talk, you don't have time to sit there for an hour and a half and learn how to trade, then of course Phil talked about it a little bit earlier, is I go over Phil's 5 stocks. I go over about about a dozen. I go over about a dozen ETFs and inverse ETFs to help keep you in the market long term, and then also some gold stocks and a couple bonus stocks, individual companies, maybe Apple or I don't know, maybe an oil stock. There's always maybe 2 to 4 bonus stocks there that I'll give to you as well, and then also you get market wrap at the end of the day, and then alerts throughout the day, right? Live alerts. So to sign up for those alerts on our website, there's this little red bell down here. You just basically click that and that'll subscribe you to our notifications, and the notification would pop up in the bottom right-hand corner of your screen, basically letting you know that we posted an alert. And then the alerts are posted on this page up here. When you click alerts, it brings you a page, and then there's written alerts Monday through Friday. All right. You also get full access to the video library, and which is right up here. You get pattern recognition videos. There's training videos that teach you how to trade on MV1, on MV2, and MV3. There's support videos and tutorials there to help you how to navigate the site, how to, use your charting software, et cetera, et cetera, et cetera. And then also you get access to Phil's Toolbox, which is this right up here. You can see our MV returns page. You get our daily info page, which includes a earnings calendar, a percent calculator, and some other little things that you might need to help you with your investing. And then also a list of Phil's 5 stocks that he's always in. So there's all these things plus the archives, and our archives are basically everything we do: coffee talk, the live trading class, the Working Investor, and market wrap. Those 4 things, they're always archived for a full week. So if you happen to miss Monday's coffee talk in the morning, you can always come back at night and watch it. You can come back the following night if you wanted to watch one of the trading classes. Say you're a working investor, right? You're a working investor, but you want to watch one of the trading classes on the weekend. You can, or you can sit there and watch 2, 3, 4, 5 classes on the weekend if you want, just to learn how to trade. Because you may be a working investor now, But maybe when you retire and you have the time and you really want to learn how to take control of this, take that out of the broker's hands, then you can do that. All right. So now that I've explained that a little bit, I'm just going to show you real quick. Again, the working investor. What we do is I take this setup here is called the MaxVest 1000. Okay, we've got our MV1, which is right up here, MV2, and MV3, and I kind of have them set up by how difficult they are. Right, this one's our long-term investing, very easy to use. This one's our MV1. There's a lot more action involved. MV3 is basically your day trading, and it's each candle represents a 15-minute tick. You have to really be focused in on that. You can't leave your computer, very much during the day if you're going to sit there and day trade. It takes a lot of patience and time and your attention. So for working investor, what I do is I take this and I go right out of there, and then I take this and I close it out as well. So now all we look at is this chart here, the MV2, which Phil tells you, it has been explaining basically all morning. It's the color-coded technology that tracks the money flow of the big institutional or institutions out there that are trading, right? So here's the watch list that I follow every day, right? I follow Phil's 5 stocks, okay, which include Caterpillar, Goldman Sachs, Intel, Schlumberger, and AT&T. Okay, those are Phil's 5 stocks. I start off the working investor by following these 5 stocks. I tell you exactly, when to buy, when to add. I explain things to you like why I'm doing it, okay? I also tell you where to put a stop in every day, right? If you don't know what a stop is what protects you in case of a pullback. All right. I also then go in and I go over these ETFs here, right? These are the 8 ETFs I was telling you about. So I go through this pretty extensive list of ETFs. There's about 12 of them there. And then I go through some metal stocks and then the bonus stocks, like I was saying earlier. So I've got right now Apple, Nike, Altria Group, Kraft Heinz, and then AGN, which is Allergen. I don't even know. Honestly, to me, I've been doing it so long, the company's name doesn't mean anything to me. What they're about doesn't mean anything to me. All that matters to me is it green on my chart or is it red? And I walk you through that, and I explain all this stuff in the Working Investor. So if you're interested in that, I mean, this is a great program for you. Okay, now let me pop this up here for you. Tommy took the time to make this graphic for me. So again, you get everything I just went over. It's posted at 2 o'clock every day, Eastern time. And the way it's designed that way because it's for you, a working person. You're at work from 8 to 5 or 9 to 5 or 9 to 6, or maybe you don't come home till 10 o'clock at night. It's designed so that when you get home, you're going to know how to set up your positions for the following day. All right. If you're new, you don't follow all those positions, by the way. Everything I just showed you, you get one. You get one stock. You decide which stock you're going to follow, but you pick one of the ones I go over in the Working Investor list, and you stick to that for 1 month. Okay. If you feel comfortable with it at the end of the month, then you can add one more stock. If you don't feel comfortable, then stick to that same stock for 1 more month. And then once you get to a 3-month period, you should have about 3 stocks in your portfolio. When you get to 6 months, now you can add 2 more stocks to your portfolio. And then for the rest of the year, you should only have 5 stocks that you're actually invested in. Okay? So Working Investor, it's all long-term. It works hand in hand with the MV2 software. It's easy to understand, right? We're always here to help you. And the best part about the Working Investor is it's included in your Phil's Gang membership at the $39.95 rate. I could probably sell this thing all day as is, just the Working Investor video with the MV2 chart by itself, separate. but we don't. We include it together. And you're getting, if you sign up today, again, you're going to get the MV2 for free for 1 month to try that out. Now, keep in mind, next month, the MV2 is $24.95 if you want to subscribe to it. Okay, you don't have to. There's no commitments. But if you want to be a good working investor, you're going to want your MV2 so you can follow along and always track your stocks. So that's the best thing about MV2 is if for some reason, you know, you're traveling and you don't have time to watch a video, you can just open up your chart and go, oh, it's green still, good. I'll stay with it. Oh, it turned red today, I'm getting out. Doesn't get any easier than that, right? So, all right, so let me close this down here. Now, also, I wanted to point out one very important question, and that is, how do I do the trades, right? Everybody says, how do I actually trade with you guys? Well, we're not stockbrokers, we're not money managers, we're not fund managers. What we're going to do is what you have to do is you have to set up a brokerage account, okay, in order to trade with us. So if you already have a brokerage account, you are more than welcome to stay with your brokerage account. You don't have to use one that we're using. If you want some recommendations, I certainly can get some of those for you. In fact, I believe I've got some right here for you. I just looked these up on Google. It took me all of 30 seconds to type in stockbrokers. And this one, I looked up basically a list of some of the top ones out there. TD Ameritrade, which is basically the one I like the best because it offers the free Thinkorswim software so you can do your trades from. $6.95 per trade. It's got 5-star rating. Their customer support is really super strong, and they have a lot of local branches all around the country. So very good company. And some of these other companies also have very good reputations. There's also some smaller companies out there. Choice Trade is one that Phil likes to recommend to people. Again, that's Choice Trade. choicetrade.com. You can check them out. I believe they're actually at 0 per trade right now if you set up an account with them. Okay, so just do your due diligence. Go to Google, type in stock traders or stockbrokers, and you're going to find a list of these names. You can check them all out. Find which one works best for you, and then you'll be better off. Now, one thing I wanted to talk about real quick before we leave, because we've got about 4 minutes, is shorting. Okay, a lot of people don't really understand what is a short. Okay, there's a difference between a short position and a short-term position, right? A short-term position would be something like on MV1 here, we do what's called a swing trade. A swing trade is a short-term position, okay, meaning you're basically in from like maybe here and you're back out up here, right? You're in down here, but you're out up here. That's a short position. Where a long position would be like let me find you a good, yeah. So you would get in on green up here and you would hold to here. Well, a short is where you want to get into the stock, but the stock is dropping. Okay, so shorting the stock means up here, you borrow from the broker X amount of shares at this high price here, and you hold it short. Okay, you hold it until you get down here and you go, okay, now you're going to buy to cover, which means you're returning the shares back to the broker, and now you're buying them at this discounted rate. So now that you have your own shares, then you bring it back up here, you raise it up, your price, your value goes up. Okay, you hold those shares, those original 100 shares or however many shares you have, then you short it down. Maybe you short it down another 100 shares when it turns red again. Okay, you don't want to short here on green, but you short on red. Here's a good example of a short that we followed. I made 50% on this one, or the gang made 50% in the working investor on this stock right here. Okay, so you short it down, and then again when it goes back up here, let me just draw it for you. Let me do a blackboard here. So this screen's going to black out here. Don't panic. You're not losing me here. So what you're going to do here, I'm just pulling up a pen here. So the market, or we're going to just use a line chart type situation, okay? I'm just kind of drawing a pattern here. All right. So up here, right, you short the stock down. Say you have 100 shares. You short it with 100 shares. You get down here, right? You buy the cover. Now you own those 100 shares. You write it up here, you've got 100 shares still, right? Now that belong to you. Now you're getting ready to short it down again because you've crossed this line on the way down. So you're going to short it maybe 100 shares. So now you're basically writing 200 shares that 100 you own, 100 the broker owns, right? Then as it turns around and comes back up again, down here, you buy the cover. Now you actually own 200 shares. I'm running out of room here, but you own 200 shares here, and you own them all the way up to the top. So the last peak, you had 100. Now you're going to have 200 on the way down and then back up. Every time you come up, you're basically going to have more shares. Okay, so every time you increase your shares, you're increasing your profits. All right, so let me clear this up. I know that's probably some pretty horrific artwork, and I apologize about that, but that's that's how it is. So just remember that the MV2, because it's all you're doing is you're following the color, right, on the way down, it gives you confidence and it keeps you from investing with emotions, okay? Because one thing that Phil taught me years ago was never trade with emotions. If you trade with emotions, you're going to get hammered because you're going to jump into a stock too fast, or you're going to get out too late, or you're going to get out too soon. And when you do those three things, you're always going to lose money. With MV2, you're going to always be in at the right time, and you're going to have our guidance here at Phil's Gang, whether it be doing the live trading class where you're really involved, you're learning how to trade, you're doing swing trades, you're in and out, maybe doing some day trades, or whether you're a working investor and you're long term, where you basically get into a position where right here, and you get out of it down here, rather than being in here, out here, in here, out here, in here, out here. See what I'm saying here? If you keep doing this kind of stuff all the way down, you have to keep in mind that you're getting hit with a brokerage fee every single time you do that, and that adds up over a period of a year, right? But imagine just taking all of that, right, and you just eliminate all these brokerage fees right here. You're in here, you're out here on the short, okay? And then if you want to go long, then you're in here, you're out up here somewhere. Very, very easy stuff, okay? Very easy stuff. So again, let's see, let me find one more for you that I'm just going to show you real quick. Facebook. All right, look at that short, okay? If you had been following MV2, you were in it long, and it turned red here, you knew to get out and go short. Look at this, okay? Tommy, you still with me?
Absolutely.
Yeah. What's the percentage on this? If you got in at 216.59 and you got out down here when it first turned green, which is 142.84, what kind of percent would they have made?
34.
34%, and all you had to do was check your MV2 every day to make sure it was still red. I mean, not too difficult, right? Okay, so we're kind of running out of time here. I wanted to do a real quick couple of questions with you, Tom, just to show them how our trading class goes every day, what we're doing. Want to pop a couple questions at me?
Okay, so part of the $39.95 fee for the Phil's Gang is that each weekday at 9:30 a.m. we do a live webinar, and that goes from 9:30 a.m. Eastern until 11 a.m. Sometimes we go over, and Phil during that class will go through the market, tell you what's happening with the different sectors. We'll look at different stocks. He'll give his recommendations. He teaches you different patterns. And then the back end of the live webinars that we take your questions. We invite you to email us with your questions so we can help you become a better educated investor. So an example would be like, Steve, I'm in Harley Davidson, HOG, and I have a long position on it. Should I stay with my long position?
So at that point, I say, okay, and I put in HOG into my charts up here, like I've got in front of you now, and I say, okay, so HOG, would I stay long? So I'm looking at it on my MV1 first, and I see that it's kind of in resistance now, so I would say no, we wouldn't, because there's resistance there. Or yes, you would stay long, but you have to keep in mind that you're going into resistance to not add until it engulfs out. Okay, now an engulfment is when a candle, let's see here, I'll show you an engulfing candle. Actually, I could probably just find one on the chart. Let me find this, change my color real quick. So on the chart, the first thing I want to do is I'm going to bring the chart in to a closer view like this. And an engulfing candle is when you see a candle like, let's see if I can find a better one here, a better example for you. Okay, see this candle back here? All right, let me just circle it here. So this candle, this large candle here is engulfing this candle before. If you add on an engulfing candle, you're always going to have success. It's going to, your position's going to keep going up long term. Okay, so we always say add on an engulfment. Over here, you have a little bit of an engulfment, but you're still under the line. So the goal here would be to basically add on a candle that kind of did like this right here. Okay, it pushed up like that, and you're always adding with your price at the top. Okay, so that's basically it. I mean, that's how we do it every day. We go through a bunch of stocks. Tom asks me several questions. I mean, we spend about 45 minutes taking questions from you, the gang member. So,
and I'll just add, while we're taking those questions, Phil and the rest of the staff is researching different stocks. They're going through the stocks and seeing what are good stocks to buy, what are good stocks to short, if we should add to our position. We're constantly in communication here with the Phil's Gang team. So while Steve is taking those questions, while myself and Steve are taking those questions, Phil loves to pop in and say, hey, I've been researching these stocks. Let's look at these, and we'll go right to those. So it's a great information sharing platform where we're teaching you, and we're also giving you stock recommendations in real time.
Exactly. And here's another one I wanted to point out. You know, Phil talks about it every day on the radio about SPY, the spiders, or the S&P 500, and how we caught our, you know, our 10%, or what was the percentage, Tom? 250.01 up to 280.72.
Around 8%.
Yeah, 8%. Okay, so, but we saw it because it turned green, right? It turned green, and if you rolled that all the way up, you're up 8%. So how can you complain about that, right? So that's it for the webinar today. Real quick, I want to show you how to join. If you want to join, we'd love to have you. So give me 1 second here. All you got to do is from the home page or any page on our website, just go right up to the top here and click Join Now. Once you do that, it'll bring you right to a shopping cart. You'll see the Phil's Gang membership is already in here. You just scroll down a little bit, click Proceed to Checkout. It's as simple as filling out your information, right? If you're already registered to the site, most of the stuff will already be there for you, so you don't have to worry about that. But go ahead and fill out your information. You get down to the bottom, you put in your credit card information, make sure you're filling out your full 16-digit number, or 15 if you're using Amex, your expiration date, your CSC code or your security code, which is always found on the back of your card unless you're using Amex, and it's a 4-digit code on the front. Make sure you check in the box to accept the terms and services, and then click place order. Usually within about 20 seconds, you'll see that your order has been received. Once your order is received, you're officially a Phil's Gang member.
And I tell you what, one of the main purposes of this chart is that we're all about not losing money. We always have a motto here, that a dedicated motto is that we want you to make profits. We tell you, the charts tell you when to get out and to take your profits, unlike your broker who's just going to keep riding it all the way. So I'll toss it back to you, Steve.
But in the end, I think what you're going to do is you're going to be a gang member for a long time, because you'll find value in everything we do here at Phil's Gang and at philsgang.com. And we appreciate your time today. We hope that you enjoy the rest of your weekend, and we'll see you on the charts.